Welcome back, traders. Going to watch another ICT lecture today. This is going to be the first of his Storyteller series. Now, I have no idea what to expect. I don't know what the difference is going to be between this and the 2025 lectures, but I'm excited to get into this new series. So let's get started right away. As always, the original video is in the description.
So what is it? What's the Storyteller series? Well, when you're looking at price action, when you're recording in your journal, you want to kind of like flesh out a narrative, you want to flesh out a bias. In hindsight, you need to do that in the beginning because you don't know what you're doing. And you look at price action after it's already happened, and you look at where the inefficiencies were, where the stops were, who was making money before the stop rate was hit, who's making money before the market reverses and goes another direction, who's trapped, who is being led to believe that their trade's going to be profitable, but then later on it fails to get to an ideal scenario objective for them. And by doing these types of things, and they need not be very long, so I'm going to try to go through it rather succinctly, but in no way, shape, or form a complete overview of what took place today or any day that I overview or review, but put it that way. But it's meant to kind of like inspire you.
Awesome. So what I'm hearing is that this series is going to be a lecture on narrative. We're going to be reading price action and telling the story of how and why price played out the way it did. I'm hoping this will blend all of the technicals we've been learning together and create a narrative of the market that makes sense.
All right, and this is the actual June delivery contract month. So it's not the continuous contract. It's not necessary because we're trading intraday. We're trading on a very short-term basis. So it's not required to use a higher time frame continuation or continuous chart. All right, so we have this gap in here. If you've been following along on X and on my YouTube channel here, you know that we were looking for that as an upside objective. It hit that like gangbusters last week and then sold off. And here is our down close candle with a fair value gap in here. So this down close candle, let's zoom in a little bit. This down close candle is a bullish order block. We traded down to it last week, and then today we opened, we traded down to it once more, and then they capitalized that discount level here, which is the opening price of that down close candle, and then sent it back above the rejection block here, okay, which is the highest up close candle. Now we have this wick to contend with. Now, I was going to draw out where the consequent encroachment level is, but it's essentially look at the same level as this high here because it's close proximity to that. So it's going to afford me the luxury of saying I'm watching price to see if it can get to this level in here, okay, which is the bottom of that old CIBI. And if it does that, then I want to see, does it have the ability to get to consequent encroachment of this CIBI? Does it get above this and trade outside of the CIBI here? And then we'll be looking for this one here. So I'm trying to avoid picking a top. As I've been mentioning, an ongoing analysis with NQ, and we're trying to avoid all that. So because of this down close candle here being a daily bullish order block, this level here, this blue line, it'll appear in the lower time frame charts until I tell you it won't be. All right, here's the hourly chart here. And real quick, you can see we traded down, and I mentioned this last week. We have a buy side invalid, sell side inefficiency, consequent encroachment of that. We hit that beautifully there. You can do that on your own chart. I shared this on my X account, by the way. And we are reaching up into this CIBI here, which is just before we get to the low of that daily sell side invalid, buy side inefficiency. So we traded up into this one here. And we're going to look inside all this price action and try to decipher what took place, and also tip my hand and tell you why I said and shared what I did on X this morning. All right, so here's the 15-minute time frame. This is a bellwether chart. That means it's one of those go-to charts where it gives you most of everything I would ever need and not even require looking at a daily chart or a 4-hour chart or an hourly chart. Okay, so all the liquidity pools, all of the pertinent imbalances, inefficiencies, and such, you can see them on the 15-minute time frame, and it's very, very easy to frame out with experience, not just because I do this video, you're not gonna be able to walk out there tomorrow and be able to do what I'm doing and what I've done. But it will help you understand the importance of this specific time frame, the 15-minute time frame. So this blue line here is that daily bullish fair value gap. You can see we dove down into that here last week, and we came back off of it, dropped back down once more here today in London, and then we consolidated around in here, traded back above, came back in, had a little bit of a stop rate here, rallied up, and took out the buy side here, and this buy side there, and drawing into that daily CIBI once again, okay? So we have a new week opening gap. I'll mention that in a moment. But on the 15-minute time frame, I was teaching this week how you can very easily look at two close proximity 15-minute fair value gaps. And those 6 levels being the high, the consequent encroachment or midpoint of it, and the low of 2 specific 15-minute fair value gaps. Now, which one is that? Well, where's the most recent one that's formed? And what's the one that formed prior to that? Just looking back, that's all you're doing. And then you use that as a canvas to study price action. When you're brand new, you don't know what you're looking for. So it gives you a context to go in and start studying. Now, what happens when the price runs away and leaves both of them? Then you start looking for the next 15-minute fair value gap. And you keep doing this continuously. So you're always having a dynamic range or canvas to study price action instead of just aimlessly staring in price action and thinking to yourself, like, I don't know what I'm looking for. So therefore, I'm wasting my time. Let me go watch Bollinger Bands and moving average crossovers. By having the very specific fair value gaps that I mentioned this morning on X, I literally walked you through it in video format too. I mentioned this one here. Now, why did I mention this one? This is the graduated perspective of it. Over time, when you practice this, you will see when you do hindsight analysis, which is what my detractors and naysayers love. They're going to look at this video and say, see, he's talking about hindsight. He's talking about this is easy. But they are not looking at what I did this morning, June 2nd, 2025 on X, where I recorded myself talking about the very fair value gaps and then uploaded the video in a manner that there's no way I could have talked for 31 minutes and then redubbed something or multiple times have, all these different outs they like to say I have. But nonetheless, this is basically anchored right to the daily bullish fair value gap. See that? So that blue line here, it intersects with that fair value gap right there. And then since I was looking at price action pre-session, towards the end of London Open, we were inside of that. So now look back in time on the 15-minute time frame. This is the one that I chose. Was important. Why? Because it was inside the high of that drop down that was a raid, taking out sell side, which makes this what? A bullish breaker. Ooh, epiphany. See how that works? Little brain synapses happening, firing. Like that sound effect? I'm paying extra money for that shit. So when we look at the imbalance in here at 15-minute time frame, we can start looking at the relationships between these two, and we can practice reading price action. We can demo trade. We can tape read, just watch and see the fluctuations. And we need not be concerned about being right or wrong about whether or not this high is going to be taken out, this low is going to be taken out, this high or that high. We don't need to worry about that in the beginning. As a brand new student of price action, using the things I'm teaching, it's important for you to know that it's not imperative for you to know what you think you need to know right away. There's skill sets, there's processes, there's routines and drills that I'm putting you through. I'm not putting you through one today if you're on X. And it delivered multiple setups. And we'll look at that before I close this video. But I don't want to go too long and ramble on about things that are going to obviously be covered as we naturally go through this video. So just know that this high is the first green level, and this here is the next buy side liquidity pool. So make reference to those numbers here, those price levels. That way it's understood what it's reaching for.
All right, so a lot of information. So far, it still sounds like the same as the 2025 lectures. I'm not hearing much about who's long, who's short, who stopped out. But anyways, we're continuing with the same concept from the last lecture, aligning the lower time frame with the higher time frame. On the higher time frame, we have a bullish bias. This blue line is the high of the daily bullish order block, and it lines up with a lower time frame PD array. Now it works in here for a while, but notice how it wasn't until after we hit this higher time frame PD array that we have a bullish fair value gap, or a BISI, right here. Remember, the bias is bullish, so we're waiting until we see displacement to the upside, and ideally after hitting a higher time frame PD array.
All right, same thing, 15-minute time frame, and we're looking at it with the drop down below this heavy thick line. I thickened it up. That's the daily bullish fair value gap, and we drove down into that there, and then we started consolidating inside that 15-minute buy side amount, sell side efficiency. And I added the gradient levels of 75 and 25%. So that way it kind of gives you a little bit more fine tuning of the opportunities that could be afforded to you as a scalper or someone that's looking for pyramiding entries that if you want to tape read or demo trade to build the affinity for that. But we reach up into the buy side here and we do it here as well. But look at the reaction off of that one right there. That fair value gap is high. And look how much time it spends inside hitting the key levels. Here we start to move away from it there. And now I'm going to drop down into a 15-minute time frame that shows a little bit more detail. So we're zooming in again. So this raid on sell side, we drop back down in, and right there we hammer the low of the 15-minute fair value gap. We rally up, trading into the other 15-minute fair value gap, which is again anchored to a PD array in and of itself. So see what we're doing? We're blending a confluence of PD arrays. We're not just looking at any one individual candlestick or PD array or focus point. We're blending a few of them. Now, if you recall, I counseled you to try to avoid trying to pick a top in the NQ. So if we see a low, high, lower low, as we have here, bullish breaker, this is going to be salient. This is going to be worthwhile if we start studying this. And inside that, going to the left, we see there's a fair value gap right there in the form of a city. So this is going to act as an inversion fair value gap at a later time. So as we go closer to the 930 opening, in the opening range, we can anticipate a likelihood of the market wanting to rally back above it and then use that as a catalyst to send it higher.
One thing I want to point out here is that this bullish breaker did not form until we traded above this high on this candle. Then you can see how price never goes below this up candle over here. Now, if you try to anticipate this breaker ahead of time, say you want to get in long over here, it doesn't actually work because price did not finish using this fair value gap back here. So you need to wait until the breaker actually forms. Also, this is another example of the importance of taking partials. If you didn't take partials on this rally up, most likely you've moved your stop up to break even or a little bit better, and then you got hit on this stop rate. Then price moved in your favor. So if you would have taken partials and just leave your stop below this breaker, you could have held on to a runner.
All right, dropping down into a 1 minute chart, getting right into the nitty gritty of this. We do have a new week opening gap here, and I'll hurry and flesh that out for you. And I want to just show you that this fair value gap that's in blue was from Friday. It was 12 minutes after 10 in the morning session. And this is Friday's week before. And I'll show you exactly where they are in a second. But this was last Friday's first potential fair value gap in the opening range between 9:30 a.m. Eastern time to 10 o'clock Eastern time. So just know that that's what these are here. And I'm not going to leave the new week opening gap levels on because it's not important. I just want to draw a parallel between this fair value gap from 10:12 a.m. 1 minute chart from last Friday is basically the same thing. So I'm not going to overburden you with all these levels. Just know that this one here, I like to keep it on there because it's basically inside of the upper quadrant of the new week opening gap. So I don't need it to be perfect. Just know that later in the afternoon, this new week opening gap high, which is last Friday's settlement close, that's going to be where buy side is. And eventually you'll see how we draw up into that. But now let's go over to this candlestick right here from last Friday on a 1 minute chart. You can see the time at 9:35 a.m. That's first presented fair value gap in the morning session on last Friday's trading, NQ. And then we have this candlestick right there, which is just simply 12 minutes after 10. I liked it, and I told you last week I liked it. And because very specific PDA arrays, we carry them forward in time, and that's why it appears in the analysis here. So right away, 1 minute chart, you can see how we were below that. So before 6 o'clock in the morning, stops were rated. We traded back up inside of it. This heavier blue line, it's eventually going to go away, and you'll see that consequent encroachment level that's thinner just above it. That will remain in the chart. But just know that we traded down into the low of the fair value gap there. We consolidated, accumulated around the consequent encroachment of that fair value gap that's noted here. Then we traded above it, hit the high, and then gravitated towards that higher 15-minute fair value gap. Worked its high here, taking out this high rather, and then we worked down below it, meandering around. We want to study how price sweeps above it and below it. And once there's a sweeping effect, then it goes right back into using it again. Sweep below it, upset any liquidity below here, get back into it, use it as low, and then where are we looking for the trade to? Higher, because we're trying to avoid what? Picking a top in the NQ. And it rallies up. Where's it rallying? Taking out highs here, okay? So again, we drop back down into it there. It rallies back up, comes back down in, pyramid, rally up, take out that first buy side. Remember the green lines I told you to remember what they were before we went further in the video? And then when we opened up here in the opening range, they sink it all the way down to take out the sell side right below these lows inside that fair value gap, down to the high of the first fair value gap I showed you to pay attention to today. Not first presented fair value gap, the first one I outlined in discussion in that video.
So this is what I'm talking about, taking partials with this big rally up, especially if you're able to hold for this buy side. Now, looking at this rally, there's actually no retracement, so you have to be cognizant of the likelihood that price would retrace. There's a lot of inefficiencies here that would like to be rebalanced. So equal lows here for a sell side sweep. If you missed your chance to get in long here before 9:30, you could trade the retracement. Here we have not one, but two fair value gaps with a volume imbalance. This is a telltale sign that price may want to retrace. And once we rebalance this first SIBI and displace lower, that's confirmation. You could have went in short on this confirmation fair value gap, stop at the high, and you can target the first presented fair value gap for a partial. Now this fair value gap is technically the 9:30 candle, but I do like it because it's much larger than the smaller first presented fair value gap. However, either one is fine and you would have been profitable. And then you can try to hold on to any contracts you have left to see if we can sweep the sell side liquidity below these equal lows. Obviously, this is in hindsight, but if you watch my 2024 backtesting series, you may have some deja vu because this is exactly how I backtested. After a liquidity sweep, I will look for a confirmation fair value gap to enter on and then target the opposite liquidity. Now, this may not be your cup of tea because generally you want to trade in the direction of the higher time frame bias, which in this case is bullish. But here, the same thing works. After this sell side sweep, we have a fair value gap. We have a confirmation fair value gap to enter long on. You have your partial at this high or this high and try to hold on for the buy side liquidity. After you take your partials, you can move your stop to below this low.
We're going to look at the first percent of fair value gap today for June 2nd, 2025 for NQ. And that's the very first percent of fair value gap here, okay? And you can see how we were using relative equal lows here, setting the stage for a initial rally up, then drops down, they clear that liquidity, goes right to the high of that 15-minute fair value gap. Then rips higher, comes back down, consequent encroachment, upper quadrant and high in that area there, leaving the lower half intact, not doing anything with it. That's exactly what we want to see if it's going to be bullish. It rallies back up into last Friday's first percent of fair value gap in gray, and then back up into the first percent of fair value gap for today, Monday. So we accumulate anything going long in here, trading up higher into that 12 minutes after 10 fair value gap from last Friday, which I shared. It was one that I liked. And you're going to ask me what that was, okay? And I'm going to just tell you honestly, it's another PD array that fair value gap is, and I don't want to teach it publicly. It will be in book, but it won't be public because there's so many people right now scratching together some Mickey Mouse version of what I'm teaching ongoing here. And they're just trying to get a book out ahead of me, but they're going to be incomplete. And I'm intending it to be that way because their books are going to be literally ridiculously misinformation. You can see all the accumulation of 10/12s fair value gap from Friday, accumulating it there and sending it up into the buy side above the high it was formed here. And then they started taking out relative equal lows where sell side would be. So they drop it down to accumulate more sell side liquidity to go long. Rallies up, and then once more we have sell side here. They take it down below that, accumulate that sell side liquidity to be counterparty to smart money being long, and they send it up higher. Moving into the future, same thing here. There's those lows we were just talking about, and then there's a fair value gap there. They hit it once more, rally up, another fair value gap there in the PM session, and they accumulate it into the final 15 minutes or so, 10 minutes of trading, market on close, and they pump it once more. That rally up in there takes us above the new week opening gap high, and I'll show you that chart in a moment. So here, this is what I kind of want you to think about. Here's how many high frequency trading setups were based on just these two fair value gaps, okay? We went below it. I told you that we would see that drop down to take the liquidity, and then it rallies up, comes back down once more, low of the day. Here's entry from here to here, this level here to that level here. That's one setup. Another one is here, using the high of this fair value gap up to the low of this fair value gap. That's a price run. How many trades is that? 2 already. 2. In a span of a very short period of time, less than a half an hour or so, you already got 2 trades on. Or you could have been using it as a long, partial, or pyramid for continuation to that one. See how you can have the flexibility. You decide what you want to do with this information. You decide. You flesh out your model. And then we have the turtle soup, which I showed myself trading, run this high here, and we'll use a draw back into that second fair value gap on the 50-minute time frame that I outlined, which is the higher of the two. So that was a short, and you watched me literally do that on X today. And then going long here to do another run up to take out that high, using the high of the fair value gap, it's in red, to run buy side. So entry here, exit here. So A is entry, B is exit. So that way you're following along in the chart. Same thing here, going long here, taking out the buy stops above that high here. So that's another trade using this simple fair value gap idea. And you keep walking forward. Every time the 15-minute chart creates a new fair value gap, you just add that on to the previous fair value gap that you were using in the series throughout the day. See how dynamic that range becomes? And you don't forget the other one. You know, like for instance, this one here, say a 15-minute fair value gap formed above this one, like up in here. Well, then you'd use this one and whatever that one was. And then this one you'd still have in your chart, but you would just work with the 2 most recent ones. And you're constantly reading order flow in relationship to those 2 15-minute fair value gaps. It gives you a dynamic ebb and flow of reading institutional order flow without garbage level 2 data, which is spoofed.
So yeah, there's no way I would be able to trade here like a high frequency algo. You need to be able to pick the correct fair value gaps and extend them forward, which I'm not very good at. I know he said to use the 2 most recent 15-minute fair value gaps, but sometimes it's not so clear. And if you don't pick the right ones, you won't be able to enter and exit at these levels. So while this looks fancy and attractive, you need to understand your strengths and weaknesses and be realistic in what you're capable of right now. Doesn't mean you can't learn this in the future, but are you able to do this right now? If you can't do this with paper trading, there's no point in throwing real money at it. I outlined in the previous slide on how I would trade this day, and having done the back testing, I can confidently say that that's something I'm capable of.
Dropping down into this here, just remember this price returned to 21,237. We'll move forward. That's here. Okay, so we can see using the first percent of fair value gap, we can see a short here in first percent of fair value gap down to this level. So entry to target, or target here. New entry here using the higher fair value gap from the 15-minute time frame up to first percent of fair value gap low. That shaded green box. Okay, so that's a trade there. Entering here inside of Friday's first percent of fair value gap in the gray, trading that up into this run up here, taking that liquidity out. You had to sit through all this time distortion, and you can pyramid here, you can pyramid here, and then finally getting out there. And you can leave a run around for the rest of the day if you wanted to try to get a new week opening gap high. So, in the past, when people watched me trade the Forex market and I ran the very small balances up to ridiculous levels, and I did it in very short time span, I was trading just like this, folks, but I was doing it with currencies. And I was trading with 4.5%, sometimes 5%. Each one of these trades, I would be risking 4.5% to 5%. And as that new equity would be building, it would allow me more lots for the currency that I was trading, building up, building up, building up, building up. And as it happens, within a month, sometimes 2.5 months, we're in the stratosphere because the equity curve is basically like the backslash.
Okay, so pretty cool lecture, a lot of good information. I'm a little disappointed because I don't really see a difference between this Storyteller series and the regular 2025 lecture series. But maybe it's on me, maybe I'm expecting too much. I was expecting this to gear more towards narrative and smart money strategies, but this seems like more of the same. So going forward, I'm going to curb my expectations. I'll just think of these as the same as the 2025 lecture series, just with a fancier name. Anyways, I hope you were able to take away some value. Please help me out by giving this video a like and subscribing for more ICT lectures. But until next time, traders, safe trading.